Good afternoon, everybody. This is 12-Minute Trading. I am Doc Severson, and I'm joined here with Dave Lukas of 12-Minute Trading. Today is Monday, the 31st of October, Halloween. So, scary market, huh? Scary market. Dave, what are you seeing in the markets these days?
Oh man, well, you and I were just talking, and it's literally happening right now. So I was watching the 5 minute, 1 day 5 minute chart, and it had gotten fully charged with our energy, and it had to squeeze on the buller bands. I said, Doc, this thing's about to release. It's going to release when we go live. Let's see which way it goes, and it's heading higher. So the S&P is at it's gone up about 5-6 points just in the last couple minutes, and this thing's releasing up. So we may be making a run back to 3,900, but today is totally expected. I think after Friday, I don't think anybody expected as big of a move as we got Friday. PCE came in a tick light, which was good, and the markets like that. But to have the type of move that we had on Friday, today's a pretty natural reaction to just kind of have a relax, kind of just sideways day, get ready for the Fed, and then I think the real movement's going to start again tomorrow. So I think that's kind of where we're at.
So, we have the Fed meeting coming up this Wednesday. This one has been just like the rest of them. It's been hotly anticipated, heavily. And then we have a jobs report on Friday coming up right after that. So, like, what do you see happening? I mean, it's impossible to predict the future, but in your world, what is your vision of what Wednesday contains?
I wrote about this to my students in my weekly advisory newsletter this weekend, and there's a few things that are really kind of coming together right now that I think are interesting. Number one, I didn't know this. I did some research. Did you know that from December 28th to about November 2nd, November 3rd, that's the 5 best days of the year in the market, going all the way back to 1950 consistently every year?
Which
So this
days?
period right now is it averages 1.6% increase in the markets during this time, most consistently out of any other 5 day stretch going back to 1950 every single year. So that puts a little perspective into Friday's jump, right? But that's a lot of movement in one day. So maybe we did it all in one day. But this period is traditionally just a very trending upward period. So that was an interesting thing that after looking at the research. Another thing that's happening is institutional inflows coming into the market right now are off the charts. The money coming in from the institutional side is way higher than it's been even, just a few weeks ago that are coming in. So we've got that happening. We've got the best 5 day stretch of the year. Typically, we've got institutional money flow coming in. We've got some news out of groups like BlackRock and others that are saying the Fed's going to soften their language a little bit, right? And here's why I think that actually may come to fruition. I think the Fed's going to raise 75 basis points. I think that's in the bag. They got to do that for credibility. Everybody expected it and everything else. But it's what they do from here is what the market is keen on, why the market is looking upwards a little bit. And that's because they have to they have an issue, and the issue is, and you can go look at the Fed, you can go look at the charts on this, but if you look at the interest on the U.S. national debt starting in about June, it was sitting around that 300 or so billion range a year, and over the last 4 or 5 months, it has gone straight up. It's like 800 billion now. And because we have all this old debt that's rolling off at essentially 0% interest rates, getting replaced by 4% interest rates, the debt's starting to really grow, the debt service, right? And so the Fed is looking at that. They have to be, because we're approaching $1 trillion in interest payments on the debt. Now, put that in perspective. I mean, the U.S. economy is a $25 trillion economy, but the inflows to the government are, $3-4 trillion a year. So we're getting to a point where a quarter of that is becoming debt service and interest. So the Fed is going to, no matter what they say, have to slow down some, because we just can't afford it unless they want to bankrupt the country, right? Now that's a whole other conversation. But so you've got that coming into this. So you've got, I think the market realizes that we're towards the end of the Fed tightening cycle. I think the Fed's going to say, hey, we're going to do 50 or 25 basis points in December based on the data, all that type of stuff. But that's the softening of the language you're going to start to see with things kind of coming to an end in the beginning of the year. So you've that all those things coming together tells me that I think we're going to continue to see some upside. And you and I were talking too, the Dow Jones in the last week or two has just gone parabolic straight up. You may want to pull that chart up and show people.
Yeah, I'll do that in a
And
minute.
its energy is Yeah, its energy is exhausted, but the other indices aren't quite there yet, right? It's moved ahead of everything else. So the other indices still, have that ability to catch up. So that gives some room for more upswing. And I think you're targeting the 4,100 level. What are your thoughts on that?
Well, let me back up for a second because I am also hoping that the Fed offers accommodative language on Wednesday that, what we're calling the pivot now. It seems like we always give some kind of, verb to the Fed as to whether or not, what they're going to do, are they going to pivot? And so we've been looking for a pivot for months now. So since they started raising rates, and the problem that I think is that every time we come to one of these junctures, so far we have been disappointed because it's like, oh, I can't believe it. And really, I think this really came to a head around Jackson Hole because Jackson Hole was where Powell is supposed to get in front of people. And this is his chance. Really, Jackson Hole is not meant as a real Fed meeting. It's meant as a, right, hey, this is my vision for the future going forward. And this is famously where Bernanke back in 2010 said, I want to tell you about a little term that I invented. It's called quantitative easing. And you guys aren't going to be able to figure out what I'm talking about for another few months. But basically, I'm going to be in the basement printing money. And it took us months to figure out, to decode exactly what he was saying. But that's specifically where those types of things should occur, was Jackson Hole. Well, Powell this year, Jackson Hole was like, like all stiff and like, nope, just going to keep on raising rates. Thank you very much. Tip your waitress.
Yeah.
I'll be here all week. Tip your waitress. And that's pretty much what he said. And the market just dove lower, and it was absolutely.
I picture Mr. T from what is it, Rocky 3? What's your prediction for the fight? Pain. Right? So that was kind of his attempt at that. Hearing you say that though, and it could be. I mean, and I said this in the newsletter, everybody too. Look, nobody's going to believe this rally till they believe it, right? The 4 phases of the market: disgust, disbelief, acceptance, euphoria, right? So I would say a couple of weeks ago when we were around S&P high 3,400s, 3,500, we were pretty disgusted. That was pretty, yeah. We were in a pretty disgust, right?
That was peak disgust, no doubt.
Yeah. Now we've rallied in disbelief, right? And this is like the rally everybody's going to hate because nobody believes this thing's just going to roll over. We're going to go to new lows. We're still in the bear. That's what everybody's thinking, right? And so nobody's going to believe it till they believe it. And it could just be that. It could just be this was our, little relief rally. And then, Powell comes out and just squashes it and brings the pain, right? And so that's entirely possible. So I'm in that camp. I won't believe it till I believe it. The only way that I'm going to believe it is if we get to 4,100 and eclipse that last high that we had and then hold it and then continue higher, right? We've got to print the higher low, and we just haven't done that yet. So and then you get into acceptance, and then it starts to run, and you get back into a euphoria, and it all starts over again, right? But that's kind of where we are, I think.
I am going to bring up a chart here, a chart or two. Let's see, give me a second here to bring these up, and let's go for the big switch, and there we go. Okay. What I've got here is a chart of the Dow. So Dave was just talking about the Dow being exhausted. What does that mean? And I think you can clearly see this over the last 2 weeks. Actually, since that CPI print that we had in mid-October, it's been straight up since that point. Now it's at very interesting. It's reclaimed 50% of the declines in the Dow since the beginning of the year. So we've reclined. The Dow has reclaimed that. It's also just gotten above the 200-day moving average, and it's also right at the descending trend line. So this is a great place for this to stall out, especially with this exhaustion level. So typically when we see something exhausted like that, we expect it to go sideways or down or somewhere in between. So this is why I have just placed a short position, basically through an option spread, to the downside on the Dow, but at the same time, what I've done is on the S&P, I think the S&P has a lot of potential to go higher yet. So we'll bring up the S&P chart, And this is a nice rally, a nice beginning, but nowhere near the potential for this. So I'm wondering if we're going to get some rotation from some of these blue chips in the Dow, take some profits, roll some money into some of the growth, which is in the S&P 500, specifically technology, which is the redheaded stepchild lately, and see if we can make up this move to 4,100. So I'm short on the Dow. I am long on the S&P. This is basically a pairs trade, what I see going on. So I don't see this in exhaustion yet, but it's going to be there if we do break out on Wednesday. So a couple of things here on Wednesday. Let's say we have two different scenarios. If we break lower, if Powell disappoints, I think this will still create a higher low, and I think we're destined. It really seems like the market wants to go higher. We've seen this recently where it's like it wants to go higher. So we're always trying to figure out what the market wants. This is just the next bear market rally. Now, after that, after we hit 4,100, you better believe I'm going to be positioning for the downside, even if that creates just what ends up being a higher low, and then we end up slingshotting higher from there. So you got to keep your mind open to pretty much everything that you could possibly see in this market, whether it goes up, down, or sideways. And this is why setting up these different pairs trades, finding out what's strong, finding out what's weak, and just go in that direction.
Doc, while you've got that, pull up the chart of the Russell, pull up the rut. I think one of the strongest charts right now is the Russell. It is held a lot better than the others. Even when we went down to discuss a couple weeks ago, the Russell is got a lot of energy left in it to still trend higher. And it seems to be behind the rest. So it's kind of like the Dow's moved ahead of everyone, which makes sense because a lot of people have cycled into the Dow stocks over the last 6 to 8 months, right? So they're pushing money into those stocks. That's pushing it higher. S&P is next. NDX and RUT are probably last because everybody moved out of tech. Maybe they're rotating back some into tech now. But I think there's a big rotation into small caps going on. And that chart's been fairly strong.
So here's
its own better than the others.
Here's something that's interesting
to watch.
For every chart, I can show you probably two different outcomes from that. So you can read into it whatever you want to. And so, like, for example, if I look at this chart right now, what I'm seeing is potentially the formation of a larger head and shoulders pattern, which we'd find out really if we fail at the 200-day moving average and start coming down here, then we've started to build that up. And basically the downside target for that is the distance from the neckline to the head. But I do agree with you that the Russell can be that, we always call it the canary in the coal mine, or kind of the leading indicator, because it definitely started the distribution way back here in November, well in front of everybody else. And so I would expect it to also break the 200. And then if it breaks the 200, I don't want it just to break the 200. It's got to smash through 2,000 and start setting up higher highs and higher lows from that. So we're going to be watching everything really closely into the end of the year through just about every market. So we're just looking for opportunity. Again, our job is not to predict the future. A lot of people have, and quite honestly, that's exactly what I used to do when I first learned about TA. Was like, oh, look at this. This is great trend lines, and I can predict the future. And that works well until it doesn't. And so
right.
the longer I think that I do this, the more I start to prepare myself for, like, it could go up, down, or sideways. And all I'm doing is using the charts and using these types of techniques to understand what I will do depending on what the price does. So that's one thing for those of you that are out there that are learning about different ways to trade and things like that. Make sure you don't make that rookie mistake of using TA to predict the future. It's more about programming yourself for what to do based on whether the price goes up, down, or sideways.
Yeah, I can't agree more with you on that. I mean, years ago, I was doing the same thing. And just like everybody else, I would get one right and I would do well. I'd get the next one wrong and I'd give it back and that sort of thing. And it was like the definition of insanity, right? Doing the same things over and over again, expecting a different result. And it just was like round and around, and not really getting anywhere. And that's when I shifted to selling. and putting the odds in my favor, right? And that made all the difference. And so nowadays, like we look at these moves, right? And we say, okay, what's the potential for this move? Where could it go on either side? I don't want to have to be right. Right. I don't want to have to be able to call direction. I just want to play outside of that, or what I call like in the margins. And so like right now, that's what we do. We're selling like iron condors on these things, but saying, okay, what's the potential for the move in either direction? Can we get outside of that and get our target that we want to get? Yes, we can. Great. Then we do that. And those work great. Right. And we just let things work for us. We don't have to be right. And I think it's a different way of looking at the market. It's a different way of trading, right? Where, you're not trying to beat the market anymore. You're not trying to be right as much as you are just trying to, let the market do its thing and just play in those margins outside of it. Right. Mm-hmm. And I think there's for us, that's worked out really, really well, especially in this bear. But I found it works really, really well in trending markets too, especially, even like what we saw before this all fell apart, those type of trades worked really consistently and continue to. So for me, it's really cemented that for me that's the way to go to create great consistent income in the markets, is to not try to be right, just play outside the margins and let the market do its thing.
A lot of people really try to complicate what it is that we're doing here, or they, throw magic dust over it. Like, I've got this black box and I've got the only way, and my indicator will show you the only way to trade this. Really, what we're doing is very, very simple. We are an insurance company. What we're doing is we're literally taking a little bit of risk out of the market on a daily basis, and somebody's paying us to take risk out of the market, just like what you do with your auto insurance or your home insurance or anything else. You're taking risk off of your hands. So somebody's willing to pay me to take risk out of the market, and I'm willing to accept it as long as I determine that it is a good risk. So I have to be that one-person insurance company. I have to be not only the agent to represent that, but I also have to be the underwriter to look at the risk and say, is that a good risk or is that a bad risk? Do I like the strikes that I'm able to sell here? And this is something that we do every day within the trading room, is that we look at the price chart and we say, hey, I want to make sure I get above 4,100 and I want to get below 3,600. Those represent the price pivots that are recently support and potential resistance up there. And as long as I can do that, then good, green light, I can put the trades on. If I can't do that, then I back slowly out of the room. Like everybody else that's listening here, like at some point in somebody's life, you've been declined an insurance company policy, or the insurance company has said, hey, we need to move on. We're not going to renew your policy for you because you fit a different profile, or we're getting out of that business or something like that. And guess what? You can do that as well too, as a one-person insurance company. So what we do is very simple. We use some very elegant techniques, and we use the power of compounding, the power of time decay as edges that we have. And a lot of it too is just experience, knowing what areas to stay away from, when to back slowly out of the room.
Yeah, and that comes with time. And I think Doc, I don't know if it's you that said it to me originally years ago, or if I heard it somewhere else, but I know you've either lived it or said it before, is that great traders learn by getting killed, finding out how they died and why they died, and then vowing never to do that again. And I think we've just died enough times to this point that we've, figured out some things that work pretty consistently,
I don't know if I told you.
That's part of it.
I don't know if that was one of mine. It doesn't sound like one of mine, but what I will tell people is you never learn a thing from a winning trade. So we catalog every trade, and then for every losing trade, I will state that there is a root cause for that losing trade, and it's up to us to find that root cause. So once we identify a root cause for a losing trade, then it goes into like, okay, don't do that again. Just like you don't throw Kyle Schwarber a fastball down the middle of the plate. He's going to yank it 440 feet to right field. The pitcher will do the same thing. It's like, okay, the last time I faced this guy, he took me a yard. And this is exactly, and they know that. They know exactly where to do it. So we do the same thing here. We understand what works. We understand what doesn't work. We know when to back away, and we know when to hit it hard. And right now is actually a time over the next couple of days, we're going to be standing to the sideline because this is typically one every 6 weeks. We have the greatest amount of event risk coming into the market, which is through the Fed meeting. And then after that, we get aggressive because all that risk premium comes collapsing out of the market and the trend comes into play.
We'll have a little reprieve again mid next week because we got an election. This has actually been, I can't remember a 3-week stretch in the markets in a long time that had this much market moving, volatile type events all packed into one stretch like that,
For some reason, I seem to think like the end of 2012 was really bad. That seemed to be, we had the fiscal cliff and all this austerity measures coming into play, and people were really freaked out about that. And as you look back, it was all a big nothing burger. It was all much ado about nothing when you look back at that. Actually, it preceded a huge rally into 2013. It was worth, I think, 35%.
Where we are. I think for this, the way we approach this right now, the market seems to want to go higher. Any excuse that it can take to do it, it'll do it. So we'll see if the Fed gives that this week. And then remember, a lot of times the move on the Fed day is not the actual move. So we've seen many times where like the market goes crazy when Powell speaks. The next day it gives it all back. So I think Thursday is going to be really the day to watch here, no matter what we do, to see where this market's really going to go off the Fed. So keep that in mind as you guys are making your decisions around trading and everything this week.
That is so true. And I wanted to thank everybody. And in fact, it looks like we've got a nice little crew that are watching us live here today. So if you're watching us live, thank you for joining us. We invite you to come along and join us every Monday as we continue to do this. And also, chances are pretty good that most of the people that watch this are watching this through a replay. So again, thank you for watching that. And let us know beforehand if there's any topics that you want us to cover. So you can either come here live, ask your question live to us with Dave and Doc live online, or you can post a question that we will credit you. Thank you for asking that question, and we will answer your question on the next session. So we'll be here next Monday, and we'll be getting ready for the midterm elections. Can't wait. Dave, any closing thoughts for today for our crew?
No, just because you mentioned it, any questions from anybody out there that you've got on your mind? We can answer those real quick before we do drop for today. And if not, no worries.
Yeah, it's a little bit of silence. Sometimes,
okay.
what I do is I'll have it playing in the background, not necessarily. But anyway, that is it for our live session for today, Monday, for Halloween. So everybody have a great scary time and enjoy the volatility, and we'll see you guys next Monday.
Bye, guys.
Thanks, everybody. Bye now.